What is going on, guys? We're back with another video. So in this video, the main purpose is just going to be to really give people an idea just like how to get started and some very important factors that you need to think about, before really putting in your own money. Just developing that plan and that strategy about how you're going to go forward with it. So first up, I just want to pull this up on the screen. So this is some ideas that I have, just like going forward. There's no specific order to this, but I believe this is a lot of important topics. And before I really get started into the nitty and gritty of all this, we need to just back it up, show people how to get started. So first up, basically it's the question pops up a lot is, like, what trading app do I use? And yeah, there's a ton of them. There's Robinhood, Webull, TD Ameritrade, Thinkorswim, E-Trade, Trade Zero. There's a ton out there. And I mean, basically, it's preference. But I think a big deciding factor in it is, are you a trader or do you plan to invest? And the difference in this is, like, if you're trading, you're probably going to look at that stock, I don't know, 3 or 4 times a day, periodically. You may look at it every 2 or 3 days, but if you're investing, like you're buying Apple, for example, and you're not going to do anything to it for, I don't know, years. You're going to let it ride till the end of the year for another year or so. And basically, if you just look at like the all-time of this chart, like yes, there is pullbacks in Apple, like every time. I mean, every stock has pullbacks, but over the course of its lifespan, it's always gone up. And honestly, it's like Apple's on my wrist, it's on our phones. Basically, Apple's everywhere, and I just can't see it going anywhere in the near future. Now, will we have a pullback on it? More than likely, but this is something that, like, if I buy Apple and it drops from 114 right now to I don't know, $90, I'm not gonna freak out. Like, that's one of those that obviously as a trader that I look at it, my account's going down, but like, I'm investing in that company, and I believe like over time it is going up. Now there is some stocks that you'll trade, and so basically, if you're going to be an investor, Robinhood, it's new, it's relatively simple to use. I have an account in it still, and I think it's very good, for like long-term trading. But if you want to be more interactive, if you're going to look at it more often, you really need a more advanced like chart to look at. And we'll get into how to read the charts here later on. But so I prefer Webull for that purpose. Now Webull can be a little more complicated. Just you get overwhelmed with the chart. You don't know like what everything means, and we'll get into that. But it's also just a little more complicated in like how to work the buying and the selling. Also, Thinkorswim, TD Ameritrade, they all do these. You can all play with the chart, change the indicators, but just my personal preference has been Webull. So yeah, that's gonna do it for what apps to use. I mean, like I said, it's personal preference. Play around with them. Some of them have paper trading. Paper trading is really very good. So basically, what I did here is I can go into this and I set, I don't know, an example of $500 here. And I can change this to any amount. I know on Webull it starts you out with like $1 million. But you could trade it, you put it at $100, $250, it doesn't matter. And what you can do is you can go in here and you can buy different stocks. And basically it's fake money. So it's showing you how you would make money or how you would lose money, and just gives you like a gauge of how the market really works as in a whole. But also, like for the more complex strategies like buying off the moving average and stuff like that, it gives you a chance to practice that and really like get a feel for what type of trading works for you. And this is pretty important because not like what works for me may not work for you. What works for somebody else doesn't work for me. I mean, there's a lot of different strategies out there. A lot of people are successful at different things, but you just got to find what your style is. So whenever you get into like buying and selling, before you actually like make that buy, you need to, like, if you're, especially for trading, if you're investing long term, you don't have to worry about this. But if you're trading it, and you're gonna look at it periodically, you're gonna want to see the growth on the account. So you need to have stops, and you need to know where you're gonna take profit. So mine is usually 10%. if I buy into a stock and it drops 10%, I sell it. That's even if I'm at a loss. I mean, I've been down $5 at that 10%, and I've been down $1,500 at that 10% before. It sucks taking the big losses, but you just got to move forward. You got to move on to the next stock and just rebound from the loss. Go back to it later. See where you went wrong. See if you could have played it better. See if maybe that drop was just out of your control, and there's nothing you can do about it. You just got to play the next one. And the winning side of that is, you can't be emotional. So don't let the loss get the best of you, because honestly, you make money and you lose money. It is life. But on the flip side is when you see your account growing, you're gonna think, oh, that stock's gonna go higher. That's just a mindset thing, and you have to take profits. So if I say 10% on a loss, and I usually like to secure profits, start securing about 5 to 10%, just depending on the stock. But let's just use 5 to 10% for an example. So what I would do is, let's say I have 1,000 shares of a company. At 5% in the profit, I would sell 250 shares. So I would sell a certain percentage. And then at 10%, I may sell 100 shares. So now I've already sold 350 shares, and I have another 650 that's still going to grow on the stock. But this way you secure profit on the way up. So if the stock is to come back down to where you entered the trade at, you're not going to have as much profit as you did at that point, but you still secured profit. So that way, if you were to exit the trade, you still made money. So that's why it is very important to always obey your stops, and you just really can't get emotional with it, because honestly, life goes on. Let's see here. So that's another thing that I want to talk about, scaling into the position. So let's just say, for example, on Microsoft, and this is just totally an example, that if I wanted to buy right here at $2 or $213, well, and I'm investing, so I may buy 10 shares here, and then once it drops to 210, I may buy 15 shares. Then once it drops here, I may buy 10 shares. And you're just going to slowly scale into your position. That way, if you do get that 10% drop, if the stock is, let me pull one up. So if we bought right here at $3 on this trade, then I would buy 100, let's say 1,000 shares in total is what I want. I'd buy 100, I'd buy another 100, and I'd keep adding until this was probably the stop, 10%, somewhere around there is probably 10%. So this way, if you loaded all 1,000 shares right here and it drops 30 cents, you're losing $300. But if you add, 250 here, 250 here, 250 here, 250 here, and then that 10% hits, you may be limiting that because you scaled into it to a $200 loss. Now, obviously, nobody wants to take losses, but losses happen. So this is why you should never put money in the stock market that you can't afford to lose. Now, I mean, I don't want to lose money. I want to make money, but shit happens, just to be honest. And you have to learn from the loss before you can become a winner. There is the fairy tale stage, beginner's luck and stuff like that. It does happen, and you will have some stuff just go crazy your way, and those are always fun. Alright, so now let's talk about some terms. So if you hear somebody say they're going long, that means they bought into the stock and they're wanting the stock to go up. Now, just because the word long does not mean that they're long-term investing. For example, I went long on a stock earlier, and 10 minutes later, I sold the stock because I was up 10-15% on my buy-in. I was happy with it. I moved on. I ate lunch. I sat on the couch, watched TV. I called it. That was it. I had enough money there that I was fine with it. Now, when they go short, that means you're going to make money as the stock goes down. There's no specific time frame for this. Mainly, where the time frames get in is when somebody says swing. So if they're swinging a trade, that means you're going to hold it overnight. It could be multiple nights. The stock has a catalyst coming up. If you're swinging Apple, I mean, you could swing Apple for technically a whole year or two, if not longer, and just ride that up. And in the last video, I talked a little bit about the moving average. So a little more on that. There's two different kinds. There's a simple moving average and there's an exponential moving average. So they're sort of similar. There's a little bit difference. It's mainly just in the way the calculation is. But on the chart, I mean, they're within like 5 to 10 pennies from each other. What always works just best for me when I'm looking at it is just a simple moving average. But basically what that is that is the average price of the stock in the amount of days that it says afterwards. So the MA9, that is the 9-day moving averages of the stock. So as the stock moves during the day, that moving average is going to change. Same way with the MA20, that's the 20-day. The 200's the 200-day. And I'll explain how to trade off this more in detail for long-term trading, as well. In the last video, I did the day trading aspect of it. And also, I said the word VWAP. A lot of people were confused by that. So that is the volume weighted average price. This usually resets daily. So with this one, it takes the average price for that amount of volume. So whatever the stock is, let's say the VWAP here, right here, as it says over here, is at $2.79. But the stock is at $2.80. That means we are buying above what the average amount of people that are buying the stock are. We're buying above what the average is. That's never good. You always want to buy usually around it. And there's really specifics about that we'll get into in later trading videos. But that is a general overview of what the VWAP is that you'll hear me talking about. And with that, I brought up the volume. So what is the volume? The volume is, it'll show it right here on Webull. You can find it on most stock things, apps, websites, whatever you want to call them. So as you can see, today's volume is 8.73 million. So that is how many shares have traded hands, just today. As you can see, this gives you the 3-month average. I don't really like to look at the average. You mainly want to play relative volume. So relative volume is the amount of volume that stock has that day compared to like the float, the total volume. That's just the way I like to look at that. So the float is how many shares are available to trade. So like right here, there's 80 million shares available to trade, and we traded almost 9 million of that. So we traded like what, 1/10, a little less than 1/10 of that. Let's just say 1/10 for simplicity. So about 1/9, 1/10 is what we traded today. Obviously, stock doesn't move a whole lot when you only trade a certain percentage. This is an example of a stock that has a lower float, and lower floats are a little more dangerous, but you can make more money. So like when you play a lower float, you don't want to, it's going to be harder to sell because there's less people purchasing and buying that stock. But once it catches volume, it's going to move quick. Example of this, OPHC has a float of 1.65 million, and on this day, then it went from $3 to $5.40. So overnight, it jumped by almost $3 whole per share. On that day, as we can see right here, there was 6.4 million shares traded that day. So this float, the entire float of that stock, basically got traded 600 times. So 600% of that float got traded. So obviously, when you're moving that much of the stock, it's going to go. And that is why, so like I say to look at high volume stocks, but that's where, like, if you look at Apple or the airlines or anything like that, they're going to have like 100 million shares traded in a day, but those stocks have billions of shares available, so they're not going to move like insane amounts. And this is why, just because of the float. Also, somebody actually put this on Twitter, sent it to me, and the question was, why are we not buying Facebook because Facebook makes billions of dollars and we're instead Zoom is trading higher than Facebook. So you can't ever buy a company just based on it being cheaper than another company, more or less, on the stock exchange. So what the guy was meaning, and I understood it, was because Facebook was like around $300 at the time, and Zoom was like at 400, like $380, $400. So he was saying, Facebook's a better company than Zoom. Why is Facebook trading lower than Zoom? Well, it may look like it's cheaper, but it's not. And so that's where you have to look at the market cap of the stock. So basically, the market cap takes in the float, which is the amount of shares available, and it adds in, that aspect of what the stock price is. So as we can see, right now, because Facebook has more shares out, and it, like, with its current price, it makes this market cap around $640 billion. Whereas if you look at Zoom, although Zoom is trading higher than Facebook, Zoom doesn't have as many shares out. It has a lot smaller of a float. So its market cap is only $74 billion. So we're talking like 6-7 times less value of the company. So you can't just buy a stock purely based on what the market or what the current share price is. You sort of got to play, that float aspect, the market cap aspect. You don't ever want to buy something when it has like really low relative volume that day. And in the later videos, I'm going to get more in detail, like how I really go about finding trades. And let's see here. I got my little notes here, the stuff I want to talk about in this video. So basically, I think that's going to do it. I really want to re-emphasize the whole, are you going to be an investor or are you going to be a trader? And if you're being a trader, you really have to be more interactive with it. That doesn't mean you have to look at it almost every single second of the day like I do. You're going to look at it, at least a few times a day. Maybe you get a lunch break at work and you can glance at it. You glance at it before you go to work. You have a little 15-minute break. You just look down at your phone and just check to see what the stocks are. And basically that is how you're going to know if you're a trader or an investor. There is some companies that you don't want to invest in for long term, and basically like penny stocks are a good example of that. You want to trade penny stocks, you don't want to invest in them. They're penny stocks for a reason. Most of the time they don't blow up to these big companies. Yes, some do make it out, but like the comparison to that is, there's hundreds, millions of kids that play high school sports. Very few of them move up to college, and even a smaller few move up to professional sports. And so basically, when you're in high school, there's a lot of those penny stocks. And when you go to college, now you've moved up to that mid-cap range, and some of them go to pro and they break out, and some of those kids, college is it for them, and they're going to do something else, and that is when those penny stock companies, fall right back off. So that's why it's, you got to be a little more careful with penny stocks and the small cap stocks, and I'd only invest in like the big names, especially ones that you're going to see, going forward. Like in my opinion, Microsoft, Apple, Nvidia, AMD. Now, I'm not saying none of these stocks are overpriced right now. I mean, they are a little bit, but honestly, those are all technology. I just don't see it going anywhere here in the near future. Like 5-10 years, they're definitely going to be there. They're always adjusting. They're always buying out their competitors. I mean, I just don't see them going anywhere. So like in those, it's okay, if they lose value. I actually bought some Apple at like $120, and it hit like 110 like 2 days later, and I ended up just buying a few more because I was like, you know what, like, I'm a trader. That hurts my account, but I have some that I invest in long term, and one of those is like a stock like that. And so I know that 10 years from now, that is going to help me with some of my student loan debt that I may have, for example. And so yeah, that's gonna do it. Later this week, I have the video coming out on every single trade that I made this week. I'm gonna start doing that, and that's gonna do it, folks. Catch you later.